When Ginkgo went public back in September 2021, they released some pretty audacious goals as part of their SPAC report. The question is, how have they been performing against these so far? Hello everyone, welcome back. My name is Arias, and today we're going through Ginkgo's results as a public company so far versus their SPAC projections, as well as reviewing their results from the first 2 quarters of this year. Let's get right into it. First, we're going to cover some news that came out during the making of this video, and that is that Ginkgo and Google Cloud have entered into a 5-year partnership in both AI and cloud. As part of this, Ginkgo will make Google their primary cloud provider. In return, Google will provide funding for development of both foundational models and fine-tuned applications. One of the more interesting parts of this agreement is that Ginkgo will actually be receiving funding, although I expect it to be fairly immaterial overall, but would be interested in any more specific guidance on the next call. This is just speculation on my part, but the funding could come in the form of credits for use on Google Cloud rather than actual cash compensation. This would allow Google to justify larger outlays to Ginkgo, which would allow Ginkgo to throw more compute to their models. Ginkgo has situated themselves well to take advantage of this partnership because, since the founding of the company, they've collected tons of data and have a huge data engine with tremendous capacity in Foundry to continue to collect high-value data going forward. In some sense, this is a validation of Ginkgo's database, data collection capabilities, and AI acumen, as it appears that Google is not just licensing Ginkgo's data, but instead buying exclusivity with Ginkgo's models that they develop on their own. I'm interested in what sort of fine-tuned applications Google will have Ginkgo develop, and if they have a specific use for them or will just make them commercially available on their cloud platform. The news catalyzed a 24% one-day jump in Ginkgo stock that I'm honestly surprised wasn't a little bit more, especially when you remember Recursion's 100% plus move off a similar deal with NVIDIA. Moving on, let's go over their Q1 earnings. They added 13 programs in Q1, up a modest 18% year over year. This is well below pace to get to their target of 100 for the year, implying they expect a major pickup in the coming quarters. This brings their total active programs during the quarter to 97, up a more respectable 52% year over year. Cell engineering services revenue was up 57% year over year to $33 million. Remember, cell engineering services revenue covers just revenue coming from Foundry services, not including downstream value, which had just $1 million in revenue in the quarter. They had biosecurity revenue of $47 million, which was down 68% year on year, but with a very solid gross margin of 52%. This massive decline is expected as K-12 testing is rolling off as is no longer needed, and they are transitioning to recurring national level testing. Even with a massive decline in revenue, biosecurity still threw off a nice $24 million in gross profit. R&D and G&A expenses were both up over 100% year over year, and this is disappointing, as I would like to see a bit more discipline in spending when the capital markets are as tight as they are for growth companies. Management did call out $19 million in non-recurring expenses related to their recent mergers and acquisitions, which, if you take out, would have put expenses up 82% year over year, better, but still needing attention. They had a loss from operations, excluding stock-based compensation, of $140 million, which is a pretty big quarterly number. It had an adjusted EBITDA loss of $100 million, which removes $75 million in stock-based comp and $19 million in M&A expenses. Now let's see how their earnings progressed in the second quarter. They added 21 programs, 8 more than in Q1, and up 62% year over year. They also reported 105 programs, up 44% year over year. Both of these represented great growth, but it will need to improve to hit their full year targets. Cell engineering services revenue was up 72% year over year and 33% quarter over quarter to $44 million. Excellent growth and on pace for their original guidance. Biosecurity revenue was $35 million with a gross margin of nearly 50%. This was down big even quarter over quarter as testing revenue continues to plummet as expected. Expenses were up a much more modest 43% and 66% year over year for R&D and G&A respectively. This is a significant improvement, but I'd still look for better numbers next quarter. They had cash and equivalents of $1.1 billion, still a reasonably secure position. They lost $121 million in Q2, meaning they still have over 2 years of runway. Overall, Q2 was solid, however, there is still room for improvement, especially in expenses control, and I would look for that over Q3 and 4. Moving on, let's jump into what I thought were the most interesting points for long-term investors from either of the conference calls. One of Ginkgo's core ideas is that biotech companies should not need to be robotics experts to take advantages of massive advances in lab automation. They can focus on being experts at taking their products to market and still reap the rewards of laboratory robotics in their work done and savings had by hiring Ginkgo to do the work for them. Each customer gets the benefits at the price they do because of all the others who work with Ginkgo pooling their funding together to develop Foundry, a unit more efficient than any one of the other participating companies' labs. This is a self-reinforcing flywheel for companies, as the more companies with Ginkgo, the more work gets done at their lab, the cheaper the work will be, and the better the work will get done, therefore attracting more partners and projects. Improvements in cost and quality are not the only benefits for Ginkgo's customers. Particularly for startups, it allows flexibility in their timing of spend. First, it allows startups to get to work much quicker. While before they needed to find lab space, hire scientists, and buy and set up equipment, now they only need to make a deal with Ginkgo, who will get to work on their product much sooner. It also allows them to scale back down R&D costs during the critical time before products have made it to market, where a company needs to preserve cash until the product starts generating its own cash flow, or until it is validated and now deserves further investment from the markets. This flexibility is a huge benefit for Ginkgo's customers, especially for startups, and will increase the odds of survival for these companies, aiding in Ginkgo's long-term potential. While the biosecurity business may have a future long-term, short-term, they are only implying $9 million a quarter in biosecurity revenue, which is pretty immaterial to Ginkgo's full picture short-term. While a longer outlook, there still could be upside for this unit, but it won't have a massive impact in the next few quarters. I will be interested in what margins they can achieve in this business on a much smaller revenue base, but we'll have to wait for Q3 for those results. Another interesting development from these calls are success-based pricing programs. This is with new programs on Foundry. Ginkgo can determine what they think the probability of success is on the proposed development program, and if it's high enough, they can offer a success-based program where Ginkgo does the development on their own dollar and only gets paid if they are successful in developing the target. This is good for the customer as they have to take less risk on, and good for Ginkgo as they should convince more customers to give them a shot with lower risk levels that they're having to take on. Some may see this as Ginkgo getting desperate to get new customers onto their platform, and that may be a legitimate viewpoint. However, I see it as Ginkgo gaining enough confidence to take on more risk, knowing they can make it pay off in the end, as they now have significant development experience and abilities. Before we get to some bad news, let me address an old bear case that I think I first heard from the Scorpion short report, and that is the Ginkgo round trips revenue. As you can see, there's a major shift in Q1 year over year from 2022 to 2023, away from related party revenue towards third party revenue, from 66% of revenue in Q1 of 2022 to just 14% in the same quarter of 2023. The ratio stayed similar at under 15% in Q2 as well. To me, while this is still material, it can't be the basis for massive criticism as it now makes up a relatively small part of their revenue. Now for the bad news. They lowered their total revenue guidance for 2023 from at least $275 million to now just $245 to $260 million. They also lowered their cell engineering revenue guidance from at least $175 million to just $145 to $160 million. This is mostly related to their projected shift to success-based contracts, and the remainder is due to market weakness. Now for what I think will be the most interesting part of this video. How is Ginkgo doing relative to their SPAC projections? For those that don't know, Ginkgo went public using a special purpose acquisition company, which allowed them to release these further out projections, unlike companies going IPO. These numbers were supposed to give investors context about what they could expect, but how have things played out so far? We will look at three key factors, those being Foundry revenue, adjusted EBITDA, and program count. Starting with revenue, in 2021, the year they went public, they posted $113 million in revenue, beating their projection by a solid 13%. That was a strong start, but it's gone downhill from there as they missed their target by 18% in 2022, despite the head start from 2021. And, with the lowered guidance, they are looking to fall short of their 2022 target a year later and miss their 2023 target by over 40%. This clearly isn't good, but optimism is to be expected in SPAC projections, and the market would have expected to be better at the time of making the projections. Nonetheless, this is disappointing. Moving on to EBITDA, they again outperformed in 2021, losing $50 million less than expected on the year. In 2022, they narrowly missed their projections, but were trending in the wrong direction, as they were expecting roughly flat losses year over year, but instead saw rapidly worsening losses. This trend is continuing in 2023, as, if they continue the losses from the first half of the year in the second, they would lose over $350 million, when they were expecting improvement to lose just $136 million. This is obviously very disappointing, and the early numbers are somewhat masked by the success of the biosecurity business throwing off positive gross profit, or else this would look even worse. Program count is a tad better, with Ginkgo again beating expectations in 2021 with 31 programs versus 23 expected. They reported 59 programs added in 2022 when they were expecting 60, which I'll say we could round up and say they hit their target. 2023 hasn't gone as well, only expecting to get 100 programs instead of the projected 136. This represents 69% year-over-year growth, and while slower than projected, it's still very fast and fares the best of these projections. These are all of these projections visualized on graphs. In red is what was expected, and while in blue is what has been reported. As you can see, nothing is keeping up, and I would hope to look at these updated in 2 years and see an inflection point to the upside with respect to all of these metrics. Now for my conclusions. I thought the Q1 and Q2 results were fine for what they were. However, they made a lot of promises for the second half of the year that they will need to live up to. That being said, downside short term would be fine for me as long as it's for inconsequential short term things. After reviewing the SPAC projections, they've fallen well behind, especially with regard to revenue and EBITDA. As for my position, I still own every share I ever have and have recently bought more at $1.73 per share. DNA makes up 4.2% of my portfolio at a cost basis of $3.30 a share. While Ginkgo isn't executing on the highest level right now, they are staying in the arena, learning and improving, and I still think they have tremendous potential going forward, even if with a fair bit of risk.